Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here. Want to talk about, I know we just talked about tariffs. We're going to talk about tariffs again. We're going to talk about the CPI. We're going to talk about mortgage-backed securities. We're going to talk about a lot of things today. So strap in, sit down, and get ready. Here we go. Let's start with tariffs. And let's start with JP Morgan lowers the recession probability, interestingly enough. So a lot of fear and loathing. I think that the media must be just having an absolute blast. There's constantly something to complain about, something to write negative news about. And then all of a sudden, here we go. We've got a potential trade deal with China. So let me rewind the tape. You guys remember the reason why there was a potential recession on the table anyway is because Trump was going to push us into a recession with all of this tariff nonsense that's been widely reported. I'm sure you've heard about it, right? So, in addition to that, businesses have been like freaking out. Investors have been freaking out. Nobody knows what the heck is going on, and everybody who's been paying attention to the news, well, it's no wonder why you would be freaking out. And then somehow magically, we've got the beginnings of a trade deal with China. Tariffs have been lowered on China. I don't want to get into the details of that. That's not really relevant to today's discussion, other than the fact that this is happening, okay? JP Morgan trimmed its forecast for probability of the U.S. economy entering recession this year after President Donald Trump reached a deal to temporarily lower tariffs imposed on imported goods from China. Okay. So again, don't want to go into all the details here. The administration's recent dialing down of some of the more draconian tariffs placed on China should reduce the risk that the U.S. economy slips into a recession this year, wrote Michael Fiorelli, Chief U.S. Economy at JP Morgan. This is interesting now. It's the administration's dialing down of the more draconian tariffs. It had nothing to do with China. It's just America. Since Trump did this on our side, we have a lower probability. Now that's good news, folks. So since then, more trade deals have been announced. We probably are going to see more positive coming out. Now, you probably won't see it reported on the news because positive stuff doesn't get reported on the news. But this is all really good for the country. The PCE report, Personal Consumption Expenditure Index, which is the Fed's inflation gauge, right? That's what they're using. Also CPI, both. They're down. Like in the twos, which is crazy. Now, a PCE reading of 3.5 would be well above the Fed's inflation target of 2%, making it more likely the Fed would delay interest rate cuts unless the labor market starts to deteriorate. The unemployment rate was 4.2% in April. JP Morgan projects the unemployment rate will peak at 4.8% in the second quarter of 2026. And you guys understand that, like, if the unemployment rate is anywhere around 4%, pretty much everybody's working because there's a whole host of people who won't work, right? I mean, that's pretty much full employment. CPI came in low, lower than they expected. But let's talk about, so usually when CPI is low, that means rates start to come down. Interestingly enough, that's not what happened. And I think it's because there's still this tariff unknown out there. But CPI is reported down. Now, of course, those are government numbers, so who knows? They might get revised here in a few months. They usually do. Be nice if they just tell us the truth out of the gate. But mortgage-backed securities, man, they moved opposite. They moved negatively on us, right? So interest rates have actually gone up. Not crazy, but they've inched up, which is not usually what happens. So there's still an unsettled market out there about the tariffs. Now, I think as the news continues to roll in, if it continues the way that it has been going, then at some point here, everybody's going to have to go, okay, well, this isn't as bad as we thought it was. And since it's not as bad as we thought it was, and inflation is down, it's time to let's let the market do what the market is supposed to do. And, low CPI, low inflation should help ease rates. And we'll see what happens. Now, again, everybody watches the Fed, and the Fed lowering rates, that really doesn't have much at all to do with mortgage rates and mortgage-backed securities. So it doesn't really matter what the Fed does. It really only matters what the mortgage-backed security market is doing. And for investor loans, a lot of that is also tied to the 10-year Treasury. So it doesn't really matter what the Fed does. I mean, it does matter, because if you guys have, home equity lines and things like that are tied to interest rates that are affected by what the Fed does, then those interest rates should come down, but not actual mortgages. And then I wanted to chat with you guys about something else here, because there's been basically this entire year so far, we're almost into June, which is month 6. That's the halfway point after we get done with June. And we talk to people a lot who are just scared to death. They don't know what to do. They don't know what's going to happen with house prices. There's conflicting stories out there, whether house prices are going to go up, they're going to go down, they're going to go sideways. There's a lot of talk about unaffordability of homes, which we've talked about here on the show. There's all of this craziness going on right now where people don't know what to do. And so I wanted to just get on here and do some math, because math is an important, it just doesn't lie. Math doesn't lie. So let's talk about this for just a second. I just talked to my director of sales the other day, and he was talking to me about a client. This is not uncommon. This happens every single week. We talk to people who have real estate that has appreciated wildly. Okay, in this particular instance, properties were purchased for about $700,000. They're worth about $2 million. They have 3 of them. Okay, so $6 million. They're rental properties. On the East Coast and on the West Coast, this is not atypical. This is pretty normal. New York, LA, places like that, rental properties, that's just what they cost. That's what properties cost. That's the affordable properties, right? So $2 million. And the net on that was about $1,000 a month. Now, granted, the person said they hadn't raised rent rates in a long time. They probably could get double that in net, because they could increase their rents about $1,000. They had great tenants. Everything was going really well. Here's the issue. At $700,000, right? Let's just do the math, and you guys can do it with me unless you're driving. So it's $1,000 a month net is $12,000 a year, divided by $700,000. That is a 1.7% cash on cash return. Now, granted, you take into consideration the massive gains, huge returns. So that's not. I'm not trying to suggest that anybody did anything wrong here. They had a positive cash flowing property, and they parked $700,000 in real estate, which was a great thing. That real estate went up in value dramatically over time, which is where most of the money is made. Well, they've got $2 million now sitting in this property that's making $12,000 a year. And let's actually increase it, because she says she can increase the rent, or I don't remember who it was. $24,000 a year divided by 2 million. All right, so we're at 1.2%. Now, that 2 million should be earning somewhere around 8% easily. And I really believe that some of the biggest gains are going to be in affordable housing. And that's because you can't make it anymore. It's very difficult to build anything that's affordable. But there are markets, there are builders who are doing some of that around the country, and putting some of this into affordable housing, some of it into some smaller multifamilies, and diversifying out of states where those particular properties are in states where they're incredibly tenant-friendly laws, and actually aggressively against landlords, and moving it where you can actually make some cash flow while you're enjoying some appreciation. Moving some of that money, 8% on 2 million, guys. I mean, that is a lot of money that is being missed, right? So somewhere in the neighborhood of a $140,000 increase in cash flow just from moving that. And that's on one property. These people have 3 properties, right? So taking somewhere in the neighborhood of $70,000 and turning it into $400,000 is what we're talking about in cash flow, and still having the ability to increase in value, have tax benefits, and enjoy someone else paying the mortgages off for you, right? So leveraging into properties where you can have, and look, if you're adverse to mortgages, you still can get a cap rate of somewhere around 7 to 7.5%. And in some markets, you can do that on new construction properties because of some of the incentives that are being given from the builders. It's really, I know everybody says it's not a great time to buy. I'm telling you it is. And I'm also telling you that entry-level homes that are really, really difficult to come by, you can buy those properties. They're going to increase in value. So again, going back to my tariff, 2 or 3 shows ago, my tariff conversation, if you think that the tariffs are going to cause the prices of goods to go up, that means house prices are going to go up, because houses are just a bunch of goods put together and land, right? So if the cost of construction goes up, then house prices are going to go up. And if the tariffs do what they purport to be doing right now, then there's a couple of things that you need to think about. Interest rates right now, people say they're high. They're really not high. They're normal, but they might come down. And if inflation can stay down, and we can get, I mean, if these trade deals come through the way they're saying, I think that the problem we're going to have in our country is finding the workforce to actually man all of these jobs that are going to be coming here. It's trillions of dollars of trade deals and money moving into the country, and jobs and factories that are supposedly going to be opening over here. And I mean, we're already at 4%, roughly right around 4% unemployment, which is almost full employment. So, and I'm not sure that we have the skilled workforce that is required. Anyway, well, I guess we'll see. But if all of that comes true, well, that just means that there's going to be all of this latent demand that's sitting out there that wants to buy a house, but hasn't been able to afford it. It seems like to me, if these kind of jobs are coming back to the States, then people are going to be able to afford homes. They're going to want to buy homes. If interest rates come down, that makes homes more affordable. And if that happens, when it does, prices are going to go up because there's going to be a mad rush again to go and buy houses because there's a pent-up demand for homes that isn't being met because people right now are having a hard time affording them. So either way, buying before either one of those things happen, it seems like to me, is a good idea, especially if you can cash flow. Because what's the worst thing that happens if you buy real estate and the real estate prices go down? If you cash flow, if the property is positive cash flow, the worst thing that happens is you ride the market out while you get your return that we just talked about. So let's say that this person did a 1031 exchange for $2 million, and they went and bought a bunch of properties, and they leveraged them, and they were positive cash flow on those properties. And then instead of the price of housing going up, Ron's wrong, price of housing goes down, and they're there for 5 years with house prices down before the house prices start going back up. What's the worst thing that happens? They trade $12,000 on each one of those, or $24,000 because we increased the rent for them, which, by the way, if you're listening, you should increase your rent. So $24,000, let's call it 25, make the math easy, right? That's $75,000, right? You trade that $75,000 for 160,000, let's call it 150 to make the math easy again, right? 150 times 3, that's $450,000. So what's the worst thing that happens? Well, the worst thing that happens in this particular scenario is that we trade $75,000 for $450,000, and we have to sit on those properties for 5 years, 8 years, whatever it takes for the market to turn around, come back up, and give another market gift. That's the downside. And if you have it's just like the stock market, right? The stock market went down when all of this tariff stuff was announced. The people who freaked out and sold after the market went down locked in their losses, and that's what they did. They lost money. People who didn't freak out, now the market is back where it was, and nothing happened. Nothing happened. Same thing in real estate. If you are forced to sell because you have negative cash flow, right? Well, then whatever the market conditions are, you're just susceptible to the market conditions. So if the market has gone down, you will lose money. That's the way it works. But if you're positive cash flow, you're not being forced to sell. You don't have to sell. You can just sit and collect whatever your return is. And someone else is paying down your mortgage for you, which is another return, and you're getting the tax benefits on that. You don't have to pay any taxes on the income that you're getting. So then you just wait out the market. The market comes back, just like we just talked about the stock market. Same exact thing. The difference in the stock market is there's no income. So when the stock market drops, there's nothing positive that's happening for you. You just have to wait it out. But that's not how it is with real estate. When the real estate market drops and you have positive cash flow, you get to continue to collect positive cash flow while you're waiting for the market. And you have somebody buying your asset for you. It'd be really cool if, when the stock market went down, if you had somebody paying for your stocks for you, and you had a really solid, awesome dividend that was coming in while you were waiting for the market to come back. Oh, and by the way, you don't have to pay any taxes on those dividends either because the government is giving you a tax break. That is why we invest in real estate, folks. So if you're out there on the coast or in the Midwest or wherever you are and you're sitting on a bunch of equity and you don't know how to do the math, reach out. Invest at rpcinvest.com. Reach out. I mean, it's the math just doesn't lie. And if you're on the coast and you're sitting on millions of dollars of equity, how about if we get your income? Let's give your income a boost. right? Why not? And again, run the worst case scenario. The worst case scenario typically is it's a pretty good scenario, all things considered. Okay, that's enough about tariffs. That's enough about interest rates. It's never enough about real estate, but I'm going to let you sleep on that one. Not if you're driving. Don't go to sleep if you're driving. Till next week, get out there, make something happen, people.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.